Hi, I'm Vishnu Srinivas, and welcome to Hawkeye. I started this podcast to give professionals an open platform to share their candid views on topics impacting businesses and economies around the world. Make sure to rate, review, and subscribe.
Got it.
Joining me today is Mark Yusko. He is the CEO of Morgancreek Capital Management. Thanks so much for taking the time to speak with me today.
No, great to be here and excited about the conversation.
Awesome. So do you want to give like a short background about yourself and your role?
Yeah, the problem is I don't do anything. I don't do short well, but the shortest version, grew up on the left coast in Seattle, made my way across the country throughout high school, ended up at Notre Dame, thought I was going to study to be a doctor, decided not to late, actually senior year. By the way, never take the MCATs if you're not going to med school. Just a terrible experience. And I went to business school instead, then got a job in the insurance business, ended up getting into the investment business completely by accident. The guy who was doing investments retired. Boss said, hey, why don't you guys run the portfolio? So we did that. And then I left there and went to from the insurance company to an asset manager called Disciplined Investment Advisors. Run by two university professors at Northwestern, so at the university link here. And it was cool. We were the first spin out from a university back when quant investing was a new idea. And we basically ran computer screens because there were no real computers back then. We literally used the VAX computer at the university because there were no PCs. And we sold the data to companies. And then someone said, hey, you guys should run money using this. So we did that. We had $1 billion back when $1 billion was a lot of money. Now we talk about trillions, but back then $1 billion was a lot. And then I got the call from the alma mater. So, we're on a college show here. I went to Notre Dame. I had a chance to go back to the alma mater. And there's a story about Lou Holtz when he was football coach at Minnesota.
Oh, right.
He had a lifetime contract unless Notre Dame called. Notre Dame called, so we went back. Sorry, I didn't say go back. He went to Notre Dame, was coach there for 11 years, did a great job. And I just wanted to be back at Notre Dame. So I went back, but I learned all about the endowment model. And the endowment model of investing kind of guided the rest of my career. I left Notre Dame, where I was the number 2 guy, to come down to North Carolina, where I was the number 1 guy, and built a team down here to manage the endowment, then left that coming up on 20 years ago to build Morgancreek. And Morgancreek Capital Management focuses on traditional investments and integrating alternative investments. And then formed Morgancreek Digital 4 years ago to focus on the crypto space.
Awesome. Yeah. So obviously we're going to dive more into crypto, but before we do, I guess what were some of the biggest takeaways or lessons you learned from kind of pioneering the endowment model?
Yeah, great question. The first was, I used to think, picking stocks or picking bonds was all there was. And I was, all excited. I was an analyst at this firm and we would, decide should we own Ford or GM. And the reality is it doesn't matter, right? What matters is do you own stocks or bonds or commodities or venture capital. It's not that I shouldn't say it doesn't matter. It's not that it doesn't matter. It's not that being an equity analyst isn't a good gig. It is. But the big contributor to returns is asset allocation. So my biggest takeaway, my biggest aha moment, my second biggest. My biggest was innovation as an asset class, which we'll get to. But this idea that asset classes drive returns, not individual securities, was a big aha. And that's really what the endowments do well. The endowment model is about 4 things, really. It's one, it's about a long duration view. So you're basically doing what's called time horizon arbitrage. Your time horizon is perpetual, right? Endowments live forever. Right. Human beings, finite life cycle, we're going to need to spend our money at some point, unless we pass it down to our kids or our philanthropy. But at the end of the day, endowments have this ability to get paid extra for taking longer term investments, private equity versus public equity, private debt versus public debt. Second is a value orientation. Right? There are only 4 types of investors, or 4 types of market participants in the world: investors, traders, speculators, and gamblers. The last 2 are not really that great. Investors are what it's all about, buying things below their fair value. Traders, fine, scalping a bit of money on either side. Really hard to do to be a good trader. It's like going to Vegas and winning. Doesn't happen very often. So the odds are stacked against you. So second thing is value orientation. Third is a high equity orientation, but equity doesn't mean stocks. It means equity, ownership. So again, you can either be an owner or a loaner. You can own equity or debt. And then currencies and commodities, the other two assets, are really just derivatives of that. But ultimately, you want to own private equity, real estate equity, commodity equity, stock equity, venture capital. And then the last one was this idea of innovation as an asset class. And to me, it's the biggest edge that you can have as an investor is if you think about all the other investments, stocks, bonds, currencies, commodities, they derive value from innovation in some way, right? A company is formed. And the example I use all the time, when I was at Notre Dame back in 96, not in school, but managing the endowment, we invested in this little company called Sequoia, which back then no one had ever heard of.
Yeah.
And now everybody knows them. And they're actually super famous for the wrong reason now with FTX. But they're famous for other reasons, for good reasons.
Of course, yeah.
But long story is we put some money into Sequoia. They put a little money in this company called Google, which at the time seemed like a really bad idea. There were 20 search engines. Why did we need 21? It was a stupid name. Now it's a verb. That's a key in life. If you can become a verb, it's a really good thing.
Made it.
But mostly it was what we didn't understand, and what the guys at Sequoia did, and what Larry and Sergey were doing, was they weren't building a search engine. They were redefining how we process information. So most people have no idea that there are 1.7 billion websites in the world. Okay, there were 0 in 1991. Today there are 1.7 billion-ish. Half are owned by Google. Well, why is that? Well, every time you type a question into Google, if it's already been asked, which is likely, it goes to a website that has all the information related to that question. Yeah. That's what indexing is. And then if it's a new question, if you actually come up with a new question, they'll create a new website for it and go find the information. And that aha moment by a couple of young guys, right? Guys in their 20s, created hundreds and hundreds of billions, in fact, trillions of dollars of wealth. And, we turned 500K into 200 million bucks. There should be a quad at Notre Dame called the Google Quad. And it was pretty amazing. And I just had this light bulb moment that investing in ideas early, in fact, it's my pinned tweet on Twitter, right? Investing in innovation is what drives great wealth creation. And to do that means you have to invest in something you believe in before others even understand it. And you'll be mocked and ridiculed and, for your non-consensus actions, but it's totally worth it. And that big innovation or big light bulb moment for me is what drove me to where I am today as a venture capitalist in the digital asset space. I believe this is the greatest innovation of the last 100 years. And that's probably a little overstatement. I mean, there are some other things like biotechnology and electrification, but this is big. Blockchain is big. And the use cases for blockchain will only multiply in coming years. And I think this is probably the greatest wealth creation opportunity I'm going to see in my lifetime.
Yeah, definitely. So let's get into the digital asset space. Obviously, we don't have to beat down the drum, but FTX and Blockfi, among others, have kind of had this collapse. And I guess a lot of other people are judging other crypto for it, whether right or wrong. So first off, do you believe that other cryptocurrencies should be punished for the failure of FTX and Blockfi, or do you
let's make a couple of things really clear here. Crypto didn't fail at all. This is not a crypto failure. No protocol broke down. No smart contract didn't work. No, there was no hack per se. This was simply bad people doing bad things, right? Hate the player, not the game. You can say Sam's a bad guy. I mean, he is a bad guy. You can say Caroline's a bad gal. She's a bad gal. But don't hate on what the exchange, right? Exchanges are not evil. And we're trying to make them out as evil. Exchanges are not evil.
Right.
And in fact, we need exchanges in order to buy and sell cryptocurrency. So you need an exchange. So this idea that exchanges are bad because one failed. Look, In the history of banking, 800 plus years of banking, there have been lots of bank failures. Lots. I mean, like thousands and thousands and thousands of bank failures.
Right.
And we don't say that banks are bad, and we don't say that banks shouldn't exist, because, savings and loan crisis, Charles Keating, bad guy doing bad things, global financial crisis, bad people doing bad things. Does that mean we should stop giving our money to Goldman Sachs and Morgan Stanley and JP Morgan? No. So this idea that one exchange goes down, look, when Mt. Gox went down, that was a much bigger deal because it was kind of the only exchange in town. And now there are 500 exchanges. And, but it was the second largest one. No, it wasn't. It was fake. There was nothing there. There was no there. And so these guys are criminals that committed fraud. Now, he wants you to believe with his PR speaking thing the last couple of days, I'm just misunderstood philanthropist, and I just don't know how to code. I didn't really know what happened, and these bank accounts were mislabeled. Bullshit. Bullshit. You knew exactly what you were doing. You committed fraud. You stole from people, and you gave the money to political candidates to buy power. That's a story as old as time, right? As old as time. People have been stealing money from the little guy to give to politicians to curry favor. From ancient Rome to the Ottoman Empire to the British Empire to America today. That is not a new story. And so I think we're blowing this all out of proportion because social media, because mainstream media doesn't want this to go away because it's part of that ethos that, this was a rags to riches. This was not a rags to riches. The dude's parents are Stanford professors. I mean, obviously they're super rich because they bought $120 million worth of property in Bahamas. How did they do that on a professor's salary? Ask your professors how much, if they have any $120 million properties. I think that was, again, misappropriation of resources. So that's a long-winded way of saying FTX is bad in the sense that they stole $10 billion. Okay, that's bad. They lied and they took down Blockfi. Didn't do anything wrong. Right? Maybe they had some poor risk management. I will agree with that. And look, we were big investors and it hurts to lose money, but our business is about making money and losing money. I mean, there is no investor on this planet, none, zero, that's never lost money. They don't exist, right? The average investor is only right about 40% of the time. The legendary investors, the legends, are right about 58% of the time. Julian Robertson, George Soros, Michael Steinhardt. So if you need to be right all the time, get a different life, right? This is not the business for you. And it's not, Soros said it best, it's not whether you're right or wrong. It's how much money you make when you're right and how much money you lose when you're wrong. So yes, we lost money in Blockfi, but we made way more money in other things, which is why, our funds are still up smartly. But at the end of the day, Blockfi is a victim, just like anybody who had a deposit at FTX. Those guys did the bad stuff. They defaulted on a loan to Blockfi. Now you could say, well, Blockfi shouldn't have had such a big loan to one company. That's fair. That's actually totally fair. But given their track record of collateral management, you could forgive them, given the fact that they went through multiple bear markets with zero loan losses up until this past summer. And it's possible, now some of the details are still a little fuzzy. It's possible that some of the rumors, and these are just rumors at this point, that Sam and FTX exchanged collateral on the loan before the bankruptcy. And if that's true, that's, again, not Blockfi's fault. That's FTX and the bad guy's fault. So look, is crypto here to stay? 100%. There is zero chance, zero. People say, Mark, you can't say zero. I'm like, yeah, I can. There's zero chance that this technology is going away. There is zero chance that we aren't migrating to blockchains, right? Just the same way we migrated from client server technology to the internet, and from the internet to the mobile net. Are people going to get, if you said tomorrow, no one can use their iPhone, what would happen? You'd have riots in the street, right? You can't take that tech. You can't say, we don't like the internet because it's ruining self-esteem of young people. It's causing strife. It's causing, fraud. It's causing. Yeah. I mean, it's an open highway that anyone can use. And so now they're saying, oh, well, we're going to regulate crypto. The senator yesterday said, we should take a pause. Crypto should take a pause until we can regulate it. You mean differently than how you regulate the highway system? Think there's ever been money transferred along the US highway system to drug dealers and terrorists? Yeah, I think that probably happened. In fact, they drive the truck bombs into Oklahoma City on a highway. So we just get rid of all the highways so you can't drive trucks? Or the internet. You think anyone has ever transferred money like fiat currency to bad people or committed bank fraud? So we're going to turn off the internet?
Yeah.
No. So we're not going to turn off blockchain. We're not going to turn off crypto, because a blockchain is a superior way of exchanging value. Right? In the old days of exchanging value, I lent you money and I wrote down in my papyrus tablet, that you owed me, 100 shekels or whatever it was. Yeah. And you come back to pay me 110. And I'm like, oh, Novish, you owe me 220, but I only borrowed 100. Says right here, 200. You didn't have a ledger. It was single entry accounting. You had to trust me, and I'm not a trustworthy guy. So I changed the number. So the Medicis came along 800 years ago and said, no, that's a dumb system. We're like dual entry accounting. You keep a ledger, Mark will keep a ledger, and we, the benevolent Medicis, for a small fee, will decide that the numbers match. Mm-hmm. And we've had that system for 800 years. Well, now we don't need to trust the Medicis or the Morgans or Bank of America that our numbers match. We have an open public ledger that is encrypted, secure, permanent, immutable, and public. So we can see that Mark has a Bitcoin. He transferred it to Vish, and boom, it happened. So we don't need a bank. You don't have to have a bank account. I don't have a bank account, my wallet to your wallet, and we don't have to pay extra fees. Like right now, if I want to transfer money to my mother-in-law in El Salvador, which I don't have, I have one in Oklahoma. But if she were in El Salvador and I want to send her money, she would get 70 cents on the dollar, because Western Union and Bank of International Settlements and Standard Chartered Bank all take a cut.
Yeah.
Okay. But if I use Strike, run by Jack Mallers, who you should have on the show, which we're investors in, she gets 100 cents on the dollar. That's better. Mm-hmm. Ooh, well, they don't like that. Western Union doesn't like that. And Western Union has been around since 1864. They would like to stay in business. But they were a telegraph company. They put voice across wires when people said, here's the crazy thing. When Western Union started, people said, that'll never work. There's no way you can put voice across copper wires. Sure enough, you could. And it actually was messages first, just the telegraph, the ones and zeros. But that stock went up 11,000% because people didn't believe in it. And then today they got into the money transfer business and they charge really high fees to transfer money around the world. But we can do that in a better way with this new technology. So the new technology is coming, and that's really exciting.
Yeah. And you touched on it just earlier, but the idea of regulation, obviously there's a lot of cry for like the SEC to get involved in this, but it can't be that simple, right? Because can we even consider Bitcoin a security if it's not really satisfying the conditions of an investment contract?
Well, there's so many points there. So one, Bitcoin clearly not a security. Is it a commodity? Probably. It's basically digital gold. And the CTFC guy yesterday said, yeah, definitely it's a commodity, like multiple times. But here's the thing. The SEC has no jurisdiction in India, no jurisdiction in China, no jurisdiction in Europe. 80% of digital asset activity happens outside the United States.
Yeah.
So the SEC can't regulate it and they can't shut it down. So what do? So the banks don't want to be disrupted. So my belief is the banks are pressuring regulators through lobbying, it's just a fancy word for corruption, through a process of saying, hey, punish these guys, go in and put onerous regulation, make it really hard to get money into the system. Mm-hmm. Okay, then what happens? all the exchanges will move outside the United States, and people will VPN into those exchanges and do their crypto outside the United States. And then those other countries will collect the tax revenues and we'll lose. Okay. Well, then we'll make it illegal. Right. Gold was illegal from 1933 to 1975. People still owned it. Unless you come to my house and search my house for the gold bars, right? Even if they're illegal, I can still have them.
Yeah.
And the problem with Bitcoin is, where are you going to find it? Right. I don't leave it on my phone, and you can come search my house, but maybe I don't leave it in my house. Maybe it's in my head. Maybe I just have my seed phrase in my head. And I mean, I guess you could put a gun to my head and make me give it to you. Fine. If the government wants to do it. And maybe that's what they're going to do with the new IRS agents. They're going to go to people's house and put a gun to their head and steal their crypto. I don't think that's going to happen. But why does an IRS agent need to be armed, by the way? Not quite sure about that. So look, is the regulation coming? For sure. There's the famous Gandhi quote that I guess Gandhi actually didn't say, but everyone says he said, that, first they ignore you, then they laugh at you, then they fight you, then you win. And he was a perfect living example of that. And this is too, right? From 2009 to 15, when Bitcoin was invented, first they ignore you, right? They're like a bunch of nerds and geeks playing with this magic internet money. Yeah, whatever, who cares? No one paid attention to it. No one even talked about it. Then in 2016, some people paid attention. 17 bull market, people paid attention, and they just laughed at it. Look, those nerds and geeks, So 2016 to 21, nerds and geeks playing with their magic internet money. 2022 to 2027, then they fight you. And they're going to fight, and they're going to fight hard because, look, the disruption of the global banking, I used to call it a cabal, but I found out that makes some people of a certain faith unhappy. So I won't say that anymore. I'll call it a cartel, but that'll probably make other people unhappy. So I don't know how, but it is what it is. We'll call it a monopoly, because it's not a monopoly, duopoly, triopoly, but the banking cartel, we'll call it a cartel, is bad, and it's going to go away, but they don't want to go away. So they're going to fight really hard not to go away. So the fight is going to be nasty, but at the end of the day, the horse and buggy people didn't want to go away. Cars are better. The train didn't want to go away. Passenger train didn't want to go away, but airplanes are better. The telephone companies liked charging us. Right now, we're talking long distance for free, right? Zero cost. They like charging $3 a minute.
Yeah.
They tried to outlaw what we're doing right now, voice over internet protocol. They tried to make it illegal, right? We would be criminals if they got that law passed. Thankfully, Al Gore, again, Al Gore did not invent the internet, but he did get this bill killed, which, okay, I'll give him some credit for helping the internet get going. But the same thing's true now is, look, you can fight good technology all you want, but at the end of the day, if it's good for humanity and it's good for business and it's good for advancement of society, it will find a use. I mean, except in cases where there's, serious dictatorship and they can control everything. Like, people in Zimbabwe have been, up until Uncle Bob finally passed, it was tough regime. But barring those few places, most of the world advances, right? We have a better life today than any time in recorded history, right? There's fewer people in poverty, fewer people starving. And, we can credit a lot of things, not the least of which is electrification or the discovery of fossil fuels, the microchip, even this has some useful, even though most of it's not very good. But anyway,
yeah,
I digress.
No, it's all good. Last point on crypto. Do you think, obviously the history of Bitcoin suggests like a pretty consistent passing of cycles, and at first glance, it seems that we're kind of approaching this tipping point, but do you think this recent turmoil around crypto could shake this up somehow?
Oh, good, great. Oh, good, great question. And one of the things I love about doing podcasts and stuff is answers are easy, right? I do the answer stuff. Talking is easy. What's really hard is coming up with good questions. So I appreciate really good questions, and that's a really good question in the sense that the 4-year cycle is coded into Bitcoin. And Bitcoin drives everything else, right? Bitcoin is the head that drives the snake of this, big winding kind of an S curve of adoption of new technology. And so the 4-year cycle is embedded in it because of the way block rewards work. Every 4 years, you cut the block reward. The miners get compensated based on block rewards. If you cut their revenues in half, they would go out of business. So the price has to rise to keep them in business, which is really kind of elegant because number go up attracts attention. It's like, us guys, we're hunter-gatherers, right? We're descended. That was our job. The women were the gatherers. We were the hunters.
Yeah.
And again, not sexist, just that's the way it worked. And so our eye follows movement. I tell the joke. This is actually not a joke, right? My wife says, "Hey, get the ketchup." I open the refrigerator door. No ketchup, honey. She walks up, grabs the bottle. If it ain't moving, I can't see it. So if it were moving, I would see it. Like if somebody were to move outside the window, I would shift and move. So the price starts moving. People look at it and people act. But then what happens is when it's below fair value at the trough in winter, the investors come in and the investors buy stuff that's below fair value.
Yeah.
Well, then when it starts to approach fair value, the traders come in and they start trying to scalp, profits and losses from longs and shorts.
Right.
Well, then the speculators come in. Well, what's a speculator? A speculator is the opposite of a hedger. So I'm a miner. I mine Bitcoin. I get my rewards. I sell them in the futures market to pay for my electricity. Someone has to take the other side of that sale. That's a speculator. They have no view on crypto per se. They just facilitating the transaction. The problem is the gamblers. The gamblers come in, they see the movement, and they're like, "Oh, this is great. I can lever this up." And so they buy something they don't understand, and they lever it, and we get the period of crypto summer, the craziness when everybody's like, "Oh, it's going to the moon." Mm-hmm. Well, that's the peak, because that's when gravity will take us back down to fair value, and the cycle will start all over again. So it's greed and fear. It's always been that way. In stock markets, it's an 11-year cycle following the business, or 7-year cycle following the business cycle. In geopolitics, it's an 11-year cycle following generations. In economies, it's a 90-year cycle, which we're entering again. We had the 1840s depression, the 1930s depression, and it's not looking good right now. Yeah. So ultimately, the cycle is real, is not going away. And just because it feels bad this time, it's just because people don't remember. It's like they say, if a woman actually remembered childbirth, there'd be no second children, because they're superheroes to actually endure that, right? And the same thing is true of markets, right? If we really remembered how painful it was when Mt. Gox went under and Bitcoin fell 84% in 12 hours, and people were like, "Oh my God, it's over. It's over." And it was trading in, a 2 handle, 2 digits in, under $100. It's a lot more than $100 today. Or when it went from 20,000 down to 3,200, I remember being on TV, December 6th, 2018. And the person on air said, "So what do you think?" I said, "Well, we just issued the Morgancreek Bitcoin Challenge, and we'll take anybody on in the Buffett style bet, $1 million for charity. Each of us put in half. You guys take the S&P, we'll take Bitcoin." I'm like, "Oh, that's crazy. I mean, it's going to zero." I'm like, "Come on, take the bet." No one would take the bet. I actually talked to Warren Buffett. He almost agreed to take it. It was kind of cool. Someone said, "Call him after 5 o'clock. He answers his own phone." I'm like, that's BS. Do you have his number? They did. I called him after 5 o'clock. He answered his own phone. It was amazing. So, and he thought about it, and he's like, "Okay, I would think about this." But then someone advised him against it. And we had one other guy, guy who runs an asset management firm, decide he would take it, and his son was like, no. There's no upside. If we lose, okay, we look like idiots. If we win, we look like idiots. So no, that's what we're supposed to do. So we're not doing it. So no one would take the bet. Now, it's a good thing they didn't, right? Because we're way ahead.
Yeah.
But at the end of the day, fear and greed are like, night and day. I mean, they will happen. When it's black as night, the sun's going to come up. And when it's bright and sunny, the sun's going to set. Inevitably, that cycle is going to continue, and greed and fear follow each other. And we're in a fear cycle right now. And it's being exacerbated by all the media and all the coverage of this joker and his ex-girlfriend, which again, if we would just stop talking about them and stop letting them talk on TV, it would go away and we could get back to building, which is what the rest of us are focused on. Because if you think about downturns, that's when all the great stuff happens. You go back to 2001, 2002, Enron debacle, WorldCom, Cisco, fraud, bad people doing bad stuff, markets collapsing, tech bubbles over, the internet's never going to work. Really? There were a lot of great companies formed in 2001 and 2002 that generated hundreds of billions of dollars of wealth over the next 20 years. And tech's still a thing, last time I checked.
Yeah, that's really well put. So let's transition quickly to just some other regular economic issues before we get you out of here. Obviously, running joke on this podcast is the idea of Fed bashing, where I've had plenty of guests either question if we even need central banks, they exacerbate problems, all that good stuff. So, time for your take.
Don't get me started. Look, I'm like the wrong guy to ask this. The Federal Reserve is neither federal nor has any reserves. It's not really a bank at all. It's basically a co-op that's owned by the banks, and they're really happy about it. And it essentially has no function other than stealing from the masses to give to the few. That's its sole job. And it was created in 1607 by the Rothschilds, in the Netherlands, the first central bank, and it was designed to steal from the masses to finance their wars. That's what it did. Mm-hmm. Then half the Rothschilds left and went to England. They created the Bank of England. That did the same thing, stole from the masses to finance their wars, and it built the British Empire. Then in 1913, we took the same model from the Rothschilds and created the Fed. Why? Well, in 1907, JP Morgan was dealing with some competition. They had passed a law that allowed trust companies to form. And trust companies were seeing assets leave the banking system to go to these trust companies. And it's like the movie It's a Wonderful Life. You had the building and loan, this little trust company against the big bank that Mr. Potter owned. Mm-hmm. And long story short, is the trusts were doing all right. So JP Morgan, famously quoted saying, "I like a little competition," said, "All right, that bank over there, Knickerbocker Trust, I think they're insolvent. I think you better go get your money." And you can look it up on Wikipedia. It's a famous picture, men with umbrellas and women in their hats and skirts running to get their money out of the Knickerbocker Trust. And then he and John D. Rockefeller, his good friend, said, "We will guarantee the banking system, just like Mr. Potter does in It's a Wonderful Life. We'll guarantee the banking system. Oh, but we're going to take over these trusts. We're going to buy them for pennies on the dollar." Like, wait, that just happened. That's what FTX was trying to do, except they actually didn't have any money. JP Morgan actually had money, and John D. Rockefeller had something better than money. I mean, he may be the greatest businessman we've ever seen, but he also had a very famous father-in-law, Amory Aldrich. Amory Aldrich was the most powerful senator, and he, with JP and John D., crafted something called the Aldrich Plan, which created the Fed, the creature from Jekyll Island, where they literally met on Jekyll Island. I mean, you couldn't make this up, right? Jekyll and Hyde, the creature. I mean, you couldn't make this up. Jekyll Island, they hatched the plan for the Fed. There's a great book written in 1910 saying, if you do this, it's going to be ugly. And there's this great picture of an octopus with its arms in everywhere, sucking money out of corporations and people's pockets and puking it into Wall Street, which is exactly what the Fed does. And so that entity from 1776 to 1913, a dollar, which we stole from the Netherlands, was called the dollar. So we called it the dollar because the Rothschilds and us were tight. Yeah. And the dollar was a dollar until from 1776 to 1913. And a couple dips around wars, but it was basically worth a dollar. There was no inflation. Inflation is a myth. Inflation is theft. Inflation is stealing from the average American to give to the rich. And that's why we have the greatest income and wealth inequality in the history of mankind now, which in 1913 was not very high. Today, it's really high. Why? Because since 1913, a dollar is now worth 3 cents. And where'd that money go? Well, it went to the rich people, because what happens is the average person doesn't own stuff, right? A poor person doesn't own things. They rent their house, they rent their car, they don't own stuff. And so their income is fixed and their ability to buy stuff goes down, right? The purchasing power goes down.
Mm-hmm.
So that wealth is extracted into the assets, stocks, real estate, et cetera, that the rich people own. And worse, they own it with leverage provided by the banking system that the Fed backstops. And when it fails, like it did in 2008, instead of letting the bad people go to jail, we just bail them out. It's really incomprehensible until you think about how politics actually works. And, we were formed as a republic, not as a democracy. We're formed as a republic.
Mm-hmm.
Republics are very different than democracies. Democracies, they say it's the worst form of government except for all the others.
Yeah.
But it's really not. And the reason it's not is it doesn't really work, because everyone's knowledge is not the same. And therefore, everyone's vote probably isn't equivalent, in the sense that you say one person, one vote. Okay. But if someone votes for something which they have no knowledge, I'm guilty of it myself. I go to a local election and I haven't done any research on the local judges. How do I pick? Do I like the person's name? Are they in the party that I like? That's I'm not saying I'm a good person for doing that. It's not good. I should probably just abstain. But then it breaks down, because if everybody isn't a well-informed voter, and so a representative democracy is a little bit better, but then you have the problem with, well, then it's just the landed gentry, and they are making the vote on behalf of their constituents, which, if they voted by the will of their constituents, would be okay, but that's not the way it works. So, not to go too deep into politics, but ultimately, the Fed exists not for the reason that people think. It's not to keep job growth, stable. It's not to keep inflation. It's to provide a means of grift to lubricate the machine at the top. And it's really sad that that's the case, but that's always been the case, really, since the 1600s. And until we have something that could fix it, oh, wait, we do. It's called Bitcoin.
Yeah.
Because Bitcoin allows us, the individuals, to be self-sovereign. It allows us to actually have a vote that matters, meaning our wealth can't be stolen from us. If you haven't seen it, if listeners haven't seen it, go to the internet and pull up Augustin, whatever his last name is, at the BIS. And he's this 400-pound guy. I used to call him Jabba the Hutt, but he looks more like Kingpin from the multiverse.
Yeah.
And he talks about why central bank digital currencies are so important, and why we, the bankers, should absolutely control how and when you spend your money. So imagine this dystopian nightmare. You get paid, today's Friday, you get paid today, and you have a couple cocktails tonight, and you drunk text about the president. You wake up tomorrow and your money is worth 70 cents on the dollar. Well, what? They could do that, right? If they have a digital currency, central bank digital currency, or you jaywalk a couple too many times, they take some money away. Or worse, right? You don't make your alimony payment, they take your money away. Or Walmart pays extra in lobbying dollars, and your money doesn't work at Target anymore. It only works at Walmart. That could never, yeah, it could. It could happen. And that's the craziness of social credit systems, social credit scoring, and a cashless society based on central bank digital currencies, which are just fiat, which is the worst kind of currency there is, because it can be devalued, on steroids and programmable. Bitcoin's different, right? It's not programmable. We know exactly how many Bitcoin will be created every 10 minutes for the next 140 years. We know that if I have one and I send it to you, I can't get it back. We know that it is permanent and immutable, right? That the Bitcoin blockchain has never been hacked, not once, right? It's been up for 14 years, 99.999% of the time, never been hacked. How many times do you have to get a new Visa number because Visa gets hacked? A lot.
Yeah.
So anyway, long answer.
No, it's all good. Appreciate the standing up for Bitcoin against all the backlash. A last question though. Speaking of inflation, it seems that every time the market gets their hopes up about it finally reaching its peak, we're crushed again. And today, kind of some breaking news, obviously in forms of stronger than expected payroll and wage. So I guess what do you
it's
think?
Nonsense. It's fake. It's fake. All the jobs numbers that get released every month are fake. They're based on something called the birth-death ratio. Okay, what's that? Well, the way it works is the BLS used to have this job of saying, all right, we're going to Bureau of Labor and Statistics. We got to count all the new workers. Well, in the olden days, you couldn't do that, right? You couldn't walk around all the all the places in the country and count the new workers. And we didn't have computers, gathering payroll taxes, so we could actually count them. So they created something called the birth-death ratio, which basically says that the longer an economic expansion goes on, they calculate the percentage of companies that are formed and the percentage of companies that die, birth, death. And then they make up a number based on that as to how many jobs were created. Well, 50 years ago, fine. But today, where we have instantaneous data on that, we don't need the birth-death ratio, but they still use it. Why? Because it smooths things. Like right now, they still claim we're in an economic expansion. On what planet are we in an economic expansion, right? Everything is rolled over from ISM to industrial production to freight rates. I mean, everything. And yet they still claim because we haven't declared, the NBER has not declared a recession, therefore the birth-death ratio still matters. So 70+% of the numbers of jobs that are created are fake. Plus, it's the holiday season and people hire part-time workers to, stock shelves. And so it's nonsense. But in a world where everything is hyper gamified and hyper socialized and instantaneous, and the high frequency traders and the bots can take advantage of individuals. Here's another stat. Pull this up sometime. The amount of money that's made in the market when the market is open, it's close to zero. All the return happens overnight. Well, who's making that money? JP Morgan, BlackRock, Ken Griffin. It ain't the investors, right? Because the market gaps based on this information arbitrage and the mainstream media nonsense. And so what happens, if you look at the market every day, if you look at 9:30 to 10, when the market opens, that's called the dumb money. It's actually a term of art. That's the retail traders reacting to last night's news. The smart money, the institutions, trade 3:30 to 4. So if you want to know what's happening in the market, do the opposite of 9:30 to 10 and do what 3:30 to 4 is doing.
Right. So, okay. So, on like kind of regarding that, do you think this speaks to like the longevity of inflation? Like,
No, inflation is dead. We're going back to deflation. There are too many, myself included, too many old people. Every day, 10,000 people in this country turn 65 for the next plus, decade. And 65 to 85-year-old people, as nice as they are, and I still got 6 more years to go, they're not productive and they don't spend a lot. And what drives economies is demographics. When you have a lot of 25 to 45-year-old people, you have high inflation, and companies have to borrow from their customers in the form of higher prices to train those young, uneducated, inexperienced workers. So if you look at every country in the world that has super high inflation, they have lots and lots of young people, not very many 45 to 65. 45 to 65 is disinflationary nirvana, the perfect environment for markets and growth. And that's what we had, but it's over. So now we're in, like Japan and like Europe, we're in the deceleration phase and a deflationary environment, which means interest rates, inflation will all head down. This period of inflation that everybody's talking about was a one-time thing caused by the lockdowns. Lockdowns were a horrible decision. And what it did is it rebased everything to zero. So oil prices literally went negative. Then they went from $0 to $120. And everybody's like, oh my God, that's inflation. No, it was $100 and today it's 80. That's actually deflation, right? Before the lockdowns, it was $100 and now it's $80.
Yeah.
That's deflation. But in the middle, it went from 0 to 140. Oh my God, that's inflation. No, it's not. It's just not. But then what they did is they printed a lot of money. So what we're seeing is the effect of not things getting better, which is what inflation is all about, is when there's excess demand for limited supply of a good or service. What we're seeing is the money is bad, right? The house I'm living in today in Chapel Hill, in theory, according to Zillow, went up 40% in the last 12 months. It's ridiculous. Did it grow? Did it get more efficient? No, it actually wore out, and I had to put money into it to keep it flat.
Right.
What happened is the money went down because we've been a republic for 246 years. Okay. In the last 2.5 years, we printed 50%, 50, half of all the money in the history of the republic. Just think about that. 244 years, half the money, 2 years, half the money. Crazy, crazy. So what happens? If I have $1 billion here and I print another $1 billion here, which has happened to the value, it just got cut in half. So that's what happened to my house. The house didn't get better. The money got worse. And that's why Bitcoin is up almost precisely 100% since the lockdowns. People say, oh, but it's down. It had a stupid period where too much leverage and bad people like FTX were spoofing it. Okay, great. I mean, SBF, but that's not real. Just like Tesla stock price at its peak was not real, right? It's not ever going back there. Never, ever, right? It wasn't real. So meme coins, GameStop, AMC, not real. Okay, yes, in short periods of time, the price can exceed the value, but ultimately value rules. And gravity, Newton was right, that eventually everything gets pulled back. And today, stocks are still well above fair value. Bonds are below fair value. Bitcoin's below fair value, although it's not very far below fair value. But anyway, a lot of stuff to talk about. It's been fun. And but you got to tell me, why hawk-eyed if you're up at the land of Go Blue?
Well, you know how it is. We are getting the best investors, economy, whatever you call them, economics people, professors, all over to share their honest, unfiltered views. We're not doing like regular TV here. We're letting people share exactly what they want to say, and I'm not influencing anything, and that's how we like to keep it.
No, it's awesome. It's just kind of funny. I realized, so, because you're up in Michigan, right?
Yeah.
So you're up in Michigan, and you got Miami colors and the Iowa name. I didn't think about that. No, it's all good. It's all good. I appreciate the neutrality. It's good.
Yeah, awesome. So thanks so much, Mark Yusko, for all these great insights. Appreciate having you on.
No, thanks for having me, and enjoy the holidays and your time away, and good luck in the big games.
I hope you enjoyed that. For more content, check out the rest of the videos on my channel. And be sure to look out every Thursday for a new episode.